Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, as always, is Michael Becker.
Hey, Paul.
So Michael and we had a great 2015 and 2016, and so we want to kind of figure out where 2017 is going to. The multifamily market has been a good market. It's been a hot market. It's been an ever-expanding market for new people coming into the marketplace, good properties that are still available. And so today, we're kind of figuring out where the 2017 market is going to go to. So the multifamily market, whether it's in the state of Texas or just on the national platform, or where 2017 multifamily is going to be. And Michael, I couldn't think of better people to bring in than the group from ARA. So we're going to have a little bit of a kind of a powwow with ARA guys. And at the table today, I want to kind of introduce everybody to Bart Wickard. So Bart handles the secondary and tertiary markets for ARA. Gentleman that has been on the podcast before, and his partner in business is a gentleman named Jacob Anderson, and his partner is Richard Furr. And they were on a podcast probably about a year and a half ago, 2 years ago?
February 2015. So
almost 2 years ago. So a lot of water under the bridge since that period of time. Some great information that has come out from Richard. He's going to talk a little bit about what's going on with the market itself, and we'll kind of figure out what's going on in the multifamily market. So I'm going to kick it over to kind of Michael. Let's start this conversation.
Hey guys, thanks for coming in. So maybe we're just going to start off a little bit with who is ARA, who are you guys? Maybe tell a little bit about the background, your individual backgrounds, and who's ARA Dallas. Maybe kind of just kick it over to Bart to start and just kind of go around the horn.
Well, thanks for having me, gentlemen. My name's Bart Wickard. Like Paul said, I run the secondary, tertiary markets division. I focus exclusively, me and my team, on the secondary markets in North Texas, and have been doing so with ARA for the last 8 years. We're the only team that I know of in Texas that focuses exclusively on these markets. And so we like to think that we found a nice niche in an area of real estate that really has been underserved over the last several years. So I appreciate you guys having me and look forward to talking further.
This is Jacob Anderson. I am also a part of the ARA team. I focus more on any deals that are located within DFW. I work here at ARA with Richard Furr, and we focus primarily on the B and C deals and within DFW.
This is Richard Furr. Pleasure to talk with you guys here today. Thank you, Paul, Mike, for having us. I've been in the multifamily business in the Dallas-Fort Worth area for 25 years, so it's been a very exciting career, and doesn't look like it's slowing down anytime soon, and looking forward for the near future.
You guys have been in the heartbeat of the apartment industry throughout the United States. I mean, Dallas-Fort Worth, would you agree, is kind of the epicenter of apartments ownership? And what does ARA stand for? Let me ask what that means first, and what type of a market share do you guys have? Because you guys are huge players on a national basis, right?
Sure. First of all, ARA stands for Apartment Realty Advisors, and we are a national group under the parent company Newmark. We have about 27 offices nationwide. Here locally in Texas, we have 3 offices, one in Houston, one in Austin, and one in Dallas. We focus exclusively on apartments. We have specialty groups that handle student housing and senior housing and affordable. So our main focus is apartments. And to your point, Paul, that Dallas-Fort Worth has been a great market for multifamily the last couple of years. It has started to get on a lot of people's radar. We are still a second-tier market in comparison to New York, San Francisco, Los Angeles, but a lot of investors from those markets are starting to realize that Dallas-Fort Worth has got extremely good fundamentals for apartments.
Richard, why is that? Why is this market so damn good?
Well, primarily it's job growth, just plain and simple. The multifamily industry is highly correlated to jobs. We've added 100,000, give or take, plus jobs for Dallas-Fort Worth per year over the last couple of years. 16 will be the same. 17 is projected to be somewhere close to that. We are, just from a demand standpoint, it's very strong. From a supply standpoint, we are building a significant amount of units. We have over probably 25,000-ish we'll deliver this year, which is a big number for any market. But given the number of jobs that continue to come on, we're still confident that those units get absorbed. Markets continues to stay healthy going forward.
So I went back and listened to the podcast yesterday that we had in February of 2015. It was episode number 10, if anyone wants to listen to it. We had Jacob and Richard on. At that time, we just got back from NMHC, the National Multi-Housing Council Conference in Palm Springs 2 years ago. We're about to go to it in 2 weeks now. And at that podcast, we talked a lot about oil. So the oil just kind of declined and what impact that was going to have on Texas and DFW specifically. Do you have any sort of comments now we're 2 years later on what actually happened to oil and how that impacted Texas and DFW?
Well, this is Bart. I think I can give a pretty good answer to that. So, Texas traditionally has been very oil and gas centric, and a lot of the job growth and creation in Texas had been correlated to oil and gas. But what we've seen over the past couple of decades is really a diversification away from oil and gas. You can look at really any of the major metroplexes and even secondary and tertiary markets. And for the most part, that reliance upon oil and gas has declined such that, we've still seen tremendous growth while the price of oil has dropped in half. So, that being said, you still have some markets that are very oil and gas heavy. Midland and Odessa, the Permian Basin, that produces a third of our country's domestic oil, has seen a decline. I know Houston, where a lot of major players have headquarters, have seen specifically office vacancies and rent decline. But for the most part, the multifamily has stayed strong, and that's because of the diversification we have in Texas.
So let me ask this. One of the things that I think happened, previous to 2015 was out-of-towners or people from the coastal markets that came to Texas would kind of look at Texas as a whole, and then you divide it into 4 major markets, and then your tertiary, secondary. One of the things I think we were talking about back then was how a lot of the people that were looking to go to Houston would maybe divert their capital and go to San Antonio, Dallas, and Austin. Is that what you guys observed? Have we seen an uptick in demand in those 3 markets? And that money that would have gone to Houston that actually went to one of the other major metros here in Texas?
Definitely, for sure, especially on the core product, the Class A product. It's because Houston's taken a really big hit, and to a lesser extent, definitely on the B and C assets also, because the market's still very volatile in the Houston area, and there's so much more security and safety here in the Dallas-Fort Worth area. It's just been more attractive to investors recently.
So one of the things I think we're all going to the conference here in a couple of weeks. One of the things I think that we'll all talk about is interest rates and kind of where they're going and what effect that's going to have on the market. So ever since the election, I think the rates went up almost 100 basis points from the day before the election to the end of the year, 2016. I think we've had a little pullback in the first couple of days of the year. Have you seen any fallout yet from that? I know it's still pretty fresh. We're less than 2 months from it. Has there been any impact whatsoever on the deals you guys are working from interest rates?
Sure. We have seen some borrowers being stretched a little thin on their proceeds due to the hike here, especially due to getting deals on a contract while the rate still have been low, and then doing due diligence, doing closing, have seen the rate hikes. In general, this is for the whole country. This is for the nation. So if you're in the market, it's something you have to deal with one way or the other. The fundamentals we have currently in the Dallas-Fort Worth market is still so strong in comparison to others. So it would be nice if we would stay at historic low levels, but it's not imperative for us to thrive here in this market. I would say the deals you're seeing coming to market now, where they are factoring in 100 basis points higher interest rates, they can factor it in, less scramble around closing. But for sure, over the holidays here, we have seen people having to come up with more proceeds on deals.
So in December, I actually changed my name from Paul Peebles to Monty Hall because I was started to be called, let's make a deal. So what Jacob's saying is absolutely correct. Is what had happened is that we put transactions under applications back in September or October when the 10-year treasuries were at, say, 178, 179, and we gave people 80% leveraged loans. So whatever the sales price is, maybe some rehab to the deal times about 80%, and we got max proceeds in the transaction. So everything was fine. Then, November comes through and we're in the middle of these transactions and Mr. Trump gets elected, and which was really a shock to the system. Everyone thought, as everybody thinks, that Hillary was going to win. And when Trump got it, it was a spike in the market in terms of interest rates. So interest rates rose, just like what Mike was saying, from 178, 179 to 260, the 10-year treasuries. Now, again, that's not the interest rate total, but, it took you an interest rate from, say, 4% or 4.10 up to almost 5.10, so almost 100 basis point difference. And so what happens on my side is that interest rates rise, debt service rises, the cost that it takes you to buy the same property rises, and then I'm forced or faced with a 125 debt coverage ratio. Again, that's the amount of money that has to be left over to pay the mortgage. And so that doesn't change. And so when interest rates rise, debt service rise, I got the coverage piece that I have to abide with. So like a teeter-totter, loan proceeds were cut. And so in some cases, not cut by $100,000 or $200,000, but $600,000, $800,000, $200,000, $2 million. So as Monty Hall, I had to, I'm not a realtor, but I try to make a deal to make sure that maybe we had to lower our sales prices a little bit or get a concession or have the borrower raise the amount of money that they were going to bring in. So ending 2016 was kind of a stressful year. And what Mike was saying is that we see interest rates come back down a little bit, settle back down the first week of January. But it was a stressful period of time, and we haven't really seen anything like that of a spike in the last, say, 2 years as much as it did in November and December. How much business did you guys close in 2016? Do you guys any ideas of what's just the raw gross numbers right now?
Sure. As we were discussing earlier about our position in the marketplace, so Dallas, or rather Texas ARA, multifamily investment sales only, sold about $5 billion worth of transactions last year. The Dallas-Fort Worth office in our secondaries market was about 40% of that. So we'll close between $1 billion and, oversimplified, $2 billion a year, 50, 60 transactions. That's what we've done pretty consistently over the last couple of years, and what we're projected to do again this year.
And how did that compare to 15 or 14?
This was a record year. 16 was a record year.
As far as dollar amount, what about like transactions as well?
Same.
Yeah. And so one of the things is kind of finally back to the first podcast we had 2 years ago. You guys were talking about cap rates, and so at the time, listen, you said that the B cap rates were about 6.5, and suburban DFW and C's were about 7.5. Is that changed a little bit in the last couple of years?
It has. Basically, we have seen the cap rates going down. I would say on the market, we have about 721,000 units here. Over the last couple of years, a lot of the B and C units have traded, and they have been upgraded. So the pool of good value-add properties that's available to the market has declined by natural factors. On those deals, we have seen the cap rates being more aggressive over the last, let's say, 2 years, just from a supply and demand aspect. I think we are going to see maybe a slight hike depending on the interest rate where we're going to kind of settle in 17 here. But in the end of the day, again, the fundamentals here in Dallas, especially for the B and C properties and where you can bring them to and what you can get in rents, the forecast is still strong. The rent growth is still strong. So I don't think we're going to see a major hike in the cap rates from where we are. But definitely the way the interest rates have been, the market, we have had some record low cap rates.
Yeah, good. So kind of going into the year, what's the first quarter looking like for you guys? How's volume been? What's kind of the sense of the overall market, nationally, Texas, and kind of locally? What are you guys expecting for the first quarter or so of 2017?
I think for us individually, and likely for the state and the nation as a whole, it would be pretty similar to last quarter, as we just discussed, factoring in some changes in the capital markets. but there's still just an abundance of buyers and sellers. We'll be taking, what you said, we were coming back from the NMHC conference this time 2 years ago. We'll be going to NMH conference here in a couple weeks, and we'll be taking as many deals that we've ever taken for sale to be pitching to potential investors.
So what's maybe some of the market sentiment from different buyers out there right now? How does it differ from the kind of your institutional type buyers that buy Class A, and then the more kind of syndicator regional type players like someone like myself that buys a lot of Class B product, and then kind of just your first timers that buy a lot of the smaller C stuff, or maybe even the tertiary secondary market stuff? So kind of what's the general sentiment and the differences between the types of buyers out there?
So on the institutional side, there's been a lot of product that has traded hands, and that's really high dollar product. We saw a little slowing down in the fourth quarter, frankly, of the Class A new development deals. I think from more of a standpoint than anything, as Paul was discussing regarding the election, the impact to the markets that had, I think it had an impact to the investors at that level as well. So I think the first quarter, second quarter, may be a little slower, maybe a little more cautious, just to see how policy shakes out, to see where capital markets shake out, and to frankly absorb all the product that's been acquired over the last couple of years. Although there will be a lot of new product coming out in the first half of the year that's just reached stabilization coming out of new construction. So it'll be interesting to see how the investment market responds to that.
Yes, and I would second Richard's thoughts on that. I think we're probably seeing the biggest volatility on new product just because the amount of units that are being produced in certain submarkets have created a short-term supply-demand issue at times. And so with the amount of units we have seen coming in locally here, the Oak Lawn markets, the uptown markets, you have seen some fluctuations there. When we look at the BC product, it has been very, very steady throughout. And I think we will see the same trend here in 17.
Any concerns in the BNC? Anything? Any storm clouds in the future? Do you see, Jacob, on the BNC product?
No, not any major threats, because still when we're looking at the amount of jobs we create here in Dallas-Fort Worth, last year we created roughly 114,000 jobs. It equates to a 747 landing with 341 people every day that gets a new job. It's not all executive, high-end paying jobs. Everyone needs a place to live. And we have really seen that the B and C assets picking those people up. So as long as our employment growth stays steady and our cost of living stays adequate to the area, I think we'll be fine.
Yeah, as I mentioned before, Richard and Jacob really work in the Dallas-Fort Worth metro market. So, that's a large 6-7 million people marketplace. But I really want to turn out and spend some time with Bart in kind of understanding a little bit more about the secondary tertiary market. And really, what does that mean? What is a secondary or tertiary market in your mind? Is it population? Is it location of the asset? How is it defined by you first?
Well, Paul, it really is kind of a loose definition. Everybody defines it differently. Like Jacob said earlier, a lot of people view Dallas as a second-tier market. To me, that's a primary market, right? And so when I talk about secondary markets in Texas, really that's going to be outside of your four major metroplexes, Dallas, Houston, Austin, San Antonio. So really any city outside of those, I would call a Texas secondary market. And typically that's going to be any city of 100,000 plus in population. The tertiary markets are going to be, the smaller towns, less than 100,000 people. Some of them are close to major metroplexes. Some of them are really out kind of on their own. Texas is a big state, and it has a lot of self-sustaining economies or microeconomies within the state. And, some of those are, smaller towns, but still have apartment complexes. People need to rent, and so there can still be opportunities there.
All right, now just between you and I, give me the top 3 secondary, tertiary markets here in Texas.
Well, that's a really good question. I guess when you say top 3, how do you want to define that in terms of opportunity or maybe fundamentals?
You define it any which way you think. Someone calls up to you and says, Bart, a lot of competition in the Dallas-Fort Worth market, but I explore the secondary, tertiary markets. They're going to say, what do you think is the best opportunity of a value in Texas?
Well, first major secondary market, I guess, that comes to mind would probably be Waco, based on its location right between Dallas and Austin on the I-35 corridor, which sees a tremendous amount of growth.
Yep.
If you look at some of the fundamentals throughout the state, I like cities like Lubbock, Amarillo. Those two cities have the lowest unemployment in all of the state. And, something it's very different about secondary and tertiary markets in relation to some of the major metroplexes is that we don't have that supply issue that could potentially affect these markets. You do have properties under construction, but not the 25,000 units, that are going to be delivered in Dallas-Fort Worth, and, not to mention Houston, Austin, and San Antonio. So that being said, you see a lot more stability, I guess. You don't have as high of peaks, but you don't have as low of valleys in some of those markets.
Are you seeing a lot of people bleed off from Dallas-Fort Worth and trying to explore into the secondary markets?
Yeah, Paul, that's really been the trend, and I really see it increasing. It seems like every quarter there are buyers that increasingly get frustrated being priced out of the major metroplexes. It's very competitive, very hard to buy deals. You have a lot of institutional capital. The cost of capital is a lot lower when buying in the major metroplexes. And so, people have money to spend, they want to invest it. And I think the natural transition is from major metroplexes to cities that still exhibit those strong fundamentals but don't have that same competitive level, which translates to better cap rates.
Yeah, I certainly am a big believer in the secondary, tertiary markets, the areas that Bart was describing about being Waco or Lubbock or out in Amarillo, or you can probably throw in Denton or Sherman or Denison or some of these other smaller towns, but they have some great employment and educational colleges that they support. I think, those are some great areas than Texas. Texas is a big country. If you go from Dallas to Santa Monica, California, the halfway point, you're still in Texas. So, it's that big of an area, and there's a lot of opportunities in different parts. So we always kind of focus on the major metropolitan areas of Dallas and Fort Worth and Austin and San Antonio, or even Oklahoma City or even Tulsa. But some of the smaller towns within Texas, smaller towns, 25, 50, 100,000 people, some great opportunities. And so I always tell people to don't walk over the smaller secondary towns, but focus in. If you're thinking about doing it, become the new sheriff in town. Have a little bit more of an impact on the community. If you're buying, say, a 200-unit apartment building in a 25, 30,000 population town, you can kind of run the show. You're the guy who can set the tone of the tempo of the apartment market in that area. How do people get your attention these days? You guys sell a lot of real estate, so you got a lot of people knocking on your door. So how do people get your attention? These are buyers. You guys are listing agents for people. Is it price only? Is it, what's getting your attention?
Paul, I think the secondary, tertiary markets act very similarly in this respect to primary markets. I think first and foremost, to get our attention, price is obviously a big driver to any decision-making process. But I always tell my sellers, pick the buyer, not the price, not the number. And I think the most important thing for us as brokers when we're trying to make recommendations to sellers is to be able to honestly say that a buyer in the past has performed as promised. That's the biggest thing. If we can say that, look, we've done a transaction or 2 or 3 with this individual and it was smooth, they did what they said they were going to do, that makes it easy to recommend that person. If you're a new buyer coming to the market and maybe haven't done a transaction with us, which is often the case, I think that the more you can do to show that I've got my ducks in a row, I've got my debt lined up, I've got my equity lined up, here's how I'm underwriting the property, I've seen the property. Show us that you're educated on what you're trying to do, and you'll get that shot on a deal.
Yeah, and I will again second what Bart said. It's the same functions in the DFW market. It's about being organized. Come to the table with a plan. Come to the table with your ducks in a row. And quite frankly, Paul, we rely heavily on a group like All Capital to help these buyers, especially if you're a new buyer. Come to the table with a partner in hand, and that can be management, it can be lender. Make sure you have the package to present. It's our job to take offers to the sellers, and the better you look and the more organized you are, the better your offer will be received.
Agreed. And track record goes a long way too. It doesn't have to be a long and lengthy track record. Literally, the old joke is if you do one deal, you're now an expert. So when you get the one deal under your belt, you've gone full circle, and it means a lot to buyers.
So kind of what I like to say is a completely unfair business. So the guys with the track record get unfair share of their deals. The guys that can have chips to trade and can leverage other non-monetary things to win a transaction certainly have an unfair advantage. So besides being organized, besides knowing your debt, your equity, are there any other things that a first-timer can do to really kind of break through and get their name on the radar screen and win that first deal and kind of get their track record established?
Well, honestly, attitude goes a long way too. Just one, giving the appearance of competence, you know what you're doing, but being positive, being assertive, being aggressive also can help make you distinct from some other guys that are maybe more passive.
So nitpicking the deal and every little thing that's wrong with it when you're on the property or on the call with the seller is not a good idea?
Doesn't go a long way.
Often. Good. So generally speaking, kind of back to just general market sentiment, so what's making the buyers nowadays buy deals? Why are they wanting to buy deals? Why are sellers wanting to sell deals? What are kind of the motivations in the marketplace from your observation when you're dealing with buyers and sellers, and why are deals transacting right now?
I think if we start with the seller side, one thing that has been a trend here is low maturities. They have been sitting on it for X amount of years. They might have a current loan on that needs to be assumed, but if they go over a certain holding period, they're locked in for the next 5 years. They might have realized a lot of equity in that deal, and they wanted to put it to work somewhere else, and that motivates them to sell it. So we see a natural flow. We have had a lot of CMBS debt, especially still coming up here in 2017, of deals that are maturing and partnerships that will say that it's time to sell.
And what about buyers? What's like the last few deals you sold? Why are the buyers out there buying today? What's their motivation?
I still think that the multifamily industry is providing above market returns when you're looking at, am I going to put my money in stock or bonds right now, or am I going to put it in apartment units? I think it still gives you a very steady income. You can fact check it probably a little better than certain stock, and I think people, they like that. Also, just being in DFW with, again, our cost index being what it is versus the coast, it drives people from the 3-4 caps to a 5-6 cap here. So it makes sense to put the money to work in Texas. You
guys see a lot of deals. Maybe you can kind of share with us maybe some of the things that you've seen that have been kind of unique or different here lately on some of the products that you have. Has there been any new amenities in the Class A stuff, Richard, that wasn't here 2-3 years ago? Has there been any new things in the B product that renovators have been doing that we didn't do a few years ago?
We kind of call that with the amenities arms race.
Yeah.
The surprising thing to me, and the maybe more interesting, is there continues to be such a demand for not just taking care of the resident, but taking care of the pets of the resident, right. And specifically the dogs. There are more tennis courts that have been turned into dog parks in the DFW area than you can count. The generation that's coming on board that's now renting, they're often less likely to be roommate-oriented, but much more likely to be pet-friendly. And the owners of these apartments are having to adjust for that.
I would say the other thing that has really picked up is the personal outdoor space. We have seen a lot of people starting to expand what used to be maybe a smaller patio. If you have the room for it, you'll expand it so you have a larger area. And that does tie into also having pets, but also having the ability not only to be in your unit, but having an area for yourself, private, where you can sit outside and enjoy your home.
Good. Is there anything on the interior of these units, or is it still pretty much the same playbook where you just do appliances and flooring and backsplashes and countertops? Is that the typical unit turns that we're doing when owners are upgrading properties?
So what we have seen is, and if we go back 2 years, I think we had what we would call now a version 1 of upgrades, where people went in with the fundamentals. They might have touched units from 1970, 1980s that have not been touched in years. So the first round, it was about fundamentals, going in, do new flooring, do new countertops, maybe some new light fixtures. But at that point, the current owner realized those gains pretty quick, pretty easy, and got a lot of equity in those deals. And then when they're selling, now suddenly the competition had gone on to the next level, which we would call a version 2 of the upgrades. And that's what we're seeing now. People going in with the next level, and that can be backsplash, that can be granite, it can be, the outdoor space. So we're seeing a lot of the deals that have been touched within the last 2 to 5 years, but reality is the market wants more.
So any ideas of what the next thing's going to be for like the arms race on units? Have you seen anything interesting or new, Richard, like in the Class A stuff, the brand new development, anything?
Interestingly enough, this is Bart. I was in Lubbock on a new development, and this gentleman, he's developed 3 or 4 communities, but he's from California. And one of the things he does is he just goes and chops deals. And in Lubbock, Texas, on his most recent new development deal, and you could apply this to a renovation or an upgrade of an existing asset, but he has tied in both the air conditioning and keyless entry into an app on an iPhone, so that now his residents can remotely unlock their door, just like a Nest thermostat, set their temperatures so that they're saving money when they're away. And that's increasingly important in Texas when it's hot in the summers and people want to keep some of those utility bills down. So I thought that was a pretty unique amenity that I haven't seen yet, that incorporates the technology age and allows residents to remotely affect different things in their apartments.
And then kind of wrap it up here finally. Are there any sort of interesting stories or recent challenges on deals that are kind of unique that you haven't encountered either for the first time or in a long time when you're doing a deal?
Nope.
You seen it all?
Well, actually, on the contrary, it seems that every deal presents a different challenge. And that's what's fun about the business. That's what's fun about real estate, is no 2 deals are the same. But, we have experience, just because we do so much. We have seen pretty much everything and have been able to maneuver around, some of the challenges. I can't say that there's something new, though.
No, but to go back to Paul's point of being a deal maker, I think it's increasingly important, and that goes with your management company, it goes with your lender, it goes with your broker. It's important you find a team that works for you and can handle different situations. We're in real estate, things happen, and you got to have a team around you that can support that change and handle it in these situations.
That's a good transition for our January 18th meeting at the Grapevine Convention Center for Old Capitol. So as listeners know, we put on typically a quarterly series. It could be more than a quarter, but a quarterly series. We bring in speakers. I think in January, talking about team members, we're going to bring in Lane Bean. Lane is Air Force Academy graduate, flies F-16s. He's an apartment owner. He's going to talk a little bit about being a team player and working through teams. That's how he's successful working with the Air Force and flying jets over Afghanistan, things like that. And joining him on that same ticket, kind of our keynote person, a gentleman named Jason Hull. And Jason's going to come in, and he went to the Naval Academy and went to Duke University, and then he was a Navy SEAL. So he's going to talk a little bit about working within teams and how important working together with teams, whether it's your broker, your management company, your mentor in the transaction, your attorney. We all have people that we have to trust being part of our team to move forward on. So we can do more things with working together as a team than we can do as an individual. So, we don't have problems with individuals, but working together with trusting team members. So January 18th, Grapevine Convention Center, 6:30. That's going to be the Old Capitol part of the lecture series on that. And then we also just signed Dr. Mark Dotzer, chief economist for Texas A&M University, just retired. Fantastic speaker on the state of the economy in commercial real estate here in Texas. If you've ever heard Dr. Dotzer talk, you will know you're in the presence of an interesting guy. He's a funny guy. He brings it down to English about what's going on with the economy. And I would think after 90 days with the Trump administration, he's going to have some feedback to everybody to what to expect for the rest of the year. So in April, Old Capital Speaker Series will feature Dr. Dotzer. So that's team building for January. How do people get a hold of you guys? I mean, you guys are major players in the Dallas-Fort Worth market and in the secondary and tertiary markets, but sometimes people get intimidated. What's the best way for them to kind of visit with you? What's the way to knock on your door?
Well, it's always a good thing to knock on the door. You can also pick up the phone and call us. We are very receptive to people calling us. And the way we work as one big team. So if you have worked with Bart in the past and you want to now look in the primary market here, call him and he will put you in touch with the best person, and vice versa. If you worked with Richard or myself before and don't know Bart, we will introduce you to Bart. So please just call or look us up on our website, aranewmark.com. And all our contact information is there.
Well, let's just go around the table. Bart, can I get you your best way to get in contact with you? Is that email?
Email, yep, bwickard, WICKARD, at aranewmark.com, or my phone number is 214-420-3116. And like Jacob said, don't be a stranger. Don't be in the shadows. We want to get to know you. We want to help you. So please don't hesitate to reach out.
My contact information, and this is Jacob. It's J Anderson, spelled JANDERSEN, at aranewmark.com. And my direct number is 214-420-3106.
Richard Furr, RFURR, at aranewmark.com. My direct line is 214-420-3119. Please don't hesitate to call.
Guys, thanks for spending some time with us in the podcast. If everybody wants to get some information on multifamily lending, we have a white paper report. It's about a 15-page, just kind of an insider's report on how to structure financing on apartment buildings. Whether it's your first time or your fifth time, we kind of lay it all out on our impression of how to get it done. Send an email to info@oldcapitallending.com. Again, info@oldcapitallending.com. And just reference the white paper. You want to get a copy of that. Mike, anything more to add today?
Just appreciate your time coming in the podcast, and here's to a good 2017.
Fantastic. Thanks for everybody joining us today, and here's wishing everybody has a great 2017. I know that you will, and thanks for listening to the podcast. We appreciate it.
Thank you, gentlemen.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.